Very good afternoon, good morning. Welcome to our live market analysis FX week ahead webinar with myself, Giles Coughlin, Chief Currency Analyst. Very good to have you here. Hope that you can see my screen and hear my voice okay. Wow, what a week we have ahead. We have Reserve Bank of Australia meeting overnight, 3:30 a.m. in the UK. We have the Federal Reserve meeting on Wednesday. We have the Bank of England meeting on Thursday, and we had non-farm payroll on Friday and Canadian jobs, as well as a smattering of data coming out from ISM manufacturing and ADP jobs data for the US. So a really action-packed week. And not only do we have those central bank meetings going on, but they are significant and with potential for considerable volatility. So we will be spending some time getting completely ready for those events. Don't forget, on Thursday, I will cover the Bank of England interest rate decision more thoroughly, as well as looking at technical entries. So on Wednesday, I've had a request to cover a special technical entry session where I'll just show people how they can find low risk, high reward entries. Now, these are the topics we're going to be looking at. Looking at the Fed, are they going to surprise markets with a dovish twist? We'll look at the potential opportunity there would be in gold if they do. Pound, all eyes on the Bank of England and their rate hike projections. We'll be looking at what SONIA futures are pricing in versus what the Bank of England really can do. Australian dollar, we'll be looking at what the Reserve Bank of Australia haven't been doing in the bond market and how that has the potential to impact significant volatility in the Australian dollar, New Zealand dollar pair. We'll also look at the Euro US dollar, which obviously is just the anti-dollar index. So it will be reasonable to remember that whatever the dollar does, the Euro US dollar pair does the opposite. CAD, we'll look at what to watch for CAD employment, and also Aussie New Zealand dollar in terms of what's going on with the New Zealand jobs data. So with that all being said, we'll now go over to our main dashboard. So I'll just change screens. That shouldn't take me very long. That's it. Should be now. Yeah, we're over onto the main screen. Right, now, just going to quickly do a rundown where we're at with majors. With so much going on this week, it's not surprising to see some pretty moderate price action, and that is what we're seeing. Pretty tame. Because a lot of volatility is due to be ahead. So most market participants don't want to commit themselves at this stage of the week. Now, commodities, seeing a bit of upside in gold, copper just finding a bit of support of that daily trend line, but copper is, a little bit, it's finding some weakness after the Chinese manufacturing and services PMI data missed. I'll give you a little tip. Copper has really been important for showing the risk tone. If price can stay above that daily trend line, I was speaking to a Reuters reporter this morning on this. This is a key level. If we can stay above this trend line, then that keeps the bullish hope alive for copper. But with stagflationary fears growing, a drop down to 4.0, 4.1 wouldn't seem unreasonable. But this is going to be the crossroads here at this trend line. Sentiment just weakening copper a little bit after Chinese data. Remember, China is one of the world's largest economy, the second largest economy in the world, above the Eurozone, but below the US. And, slowing demand in China would tend to weigh on copper prices. Copper's nickname is Dr. Copper, so it gives a good indication of global health. So crude complex finding some support. We know the issue with crude. It's low inventories, high demand. That's been supporting oil. Not been wanting to get in at those levels. Any retracements back down to 77 would seem reasonable for some upside. Looking at bond yields, yields are pretty flat today. They've generally been supported higher as what's been happening is the front end of bond yield curves have been rising higher quickly. And when the front end of a bond yield curve, when I say the front end, a yield curve would be something like 6 months, 1 year, 2 years, 3 years, 5 years, 10, 20, 30 years, all plotted on a graph, and the yield will be plotted and made a curve. So, for instance, you can see here, this is US 10-year yield. So the US 10-year yield is 1.58, but if you looked here at like US 5-year yields, you can see that it's 1.22. And if you looked at US 2-year bond yield, you can see, look, it's 0.51. So what's been happening is the front end of the yield curve, like your 6 months, your 1 year, your 2 years, has been rising sharply higher as central banks are expected to raise interest rates. Now the tail end of the yield curve has been dropping lower, because what markets are fearing is that central banks are going to raise interest rates soon, but that's going to restrict growth and inflation going on. So that's why we've been having what's called the flattening of the yield curve. So that sort of pressure is really growing at the moment. So just be aware of that dynamic. Looking at equity futures markets, you can see that S&P, Dow, Nasdaq just pulling back from their all-time highs. Now the medium-term outlook for stocks and equities remains tilted to the upside, but what you have to be aware of is that look at prices, these all-time highs. So with prices at these all-time highs, it's almost impossible to enter in at these very high levels. So don't really want to be entering in at these very high levels right now, but any deeper pullbacks to major support still remains opportunities for dip buying. Now, some analysts are saying that the strength we're seeing in the dollar at the moment is on pre-positioning ahead of the FOMC on Wednesday. I don't necessarily think that is the case, but just to be aware of that. Now, I want to point out to you something with gold, and then we'll get into the calendar. Gold, which is the yellow line chart, that's gold prices. Okay, you can see it's 1783. Now, this is real yields, and this is the dollar index. When you have the dollar index and the real yields moving in the same direction, that's when you get the most movement from gold. So when real yields and the dollar are both moving higher, gold's moving lower. So when you get real yields and the dollar moving lower, that's when you get gold moving higher. So at the moment, dollar's moving higher and real yields are moving higher, and that's just sort of pressurizing gold a little bit. But if the dollar sinks with a dovish Fed, that means yields will drop, and all a real yield is, it's the bond yield minus inflation expectations, and we all know inflation expectations are high, right? So if the Fed is dovish on Wednesday, you'd expect the dollar to sink, yields to sink, but inflation expectations to remain reasonably high, and that should push gold back up towards that 1830 and above region. So one of the best opportunities this week could potentially come on the gold chart. So just one. The gold chart is very, very bullish on the weekly chart. There's a huge technical reversal signal. You see this large pin bar? It's a reversal hammer. And if we get a dovish Fed, then we could easily expect this to move much higher. Now, you see that weekly chart? You see you have a Harami inside bar pattern here. So if this breaks above this high, above 1812, then the next stop is we're looking for a move up to 1830. Right? And if they do get a dovish Fed, then it wouldn't be unreasonable to be looking at a retest at 1900. A lot of people are very, very excited about gold. Now, I'm not one of them, because in a stagflationary environment, gold would tend to benefit. So I'm not getting ahead of myself, but in the near term, if we do see a dovish Fed, then we see the dollar sink, yield sink. That would be a nice upside for gold. 1900 does look very reasonable. So keep your eye on that for potential opportunities on Wednesday. So with that being said, let's now look at the key calendar, and then I'll just run through all the different events that we've got. Right, let's go here. Excuse me, right, just go back to there we go, right. So we have ISM manufacturing coming up. Now, yes, it's important, but it's going to not be so important because the Fed are meeting on Wednesday. So 60.4 expected. If you get anything above 62, that should be dollar upside, gold downside. Anything below 58 is going to make us more likely to see a dovish Fed. So that would be dollar downside, gold upside, and equities gaining. So that's ISM manufacturing. Interestingly, with the RBA, now this is a long story, but I'll try and tell you it short. The COT report, the latest COT reports, has seen, we've been seeing a lot of weakness in the Australian dollar. Hedge funds, leverage funds have been selling the Australian dollar for some time. It's looking very stretched. Now, one of the things that the Reserve Bank of Australia have been doing is they've been doing yield curve control, which is when they artificially buy bonds in order to keep the yield low. Now, last week, they stopped doing that. So the question is why? Why have the RBA stopped doing that? Is it because they're going to turn more hawkish this week? Now, if they are going to turn more hawkish this week, the pair to look at is the Australian dollar, New Zealand dollar pair. Now, let me just show you. Now, this is a trade I have taken prematurely, right? Because I am expecting to see a hawkish RBA. So I've gone long the Aussie New Zealand dollar. Now, whenever you're trading the Australian New Zealand dollar pair, this is the pair to trade when you are looking for interest rate differentials between the Bank of Australia and the Bank of New Zealand. So this is the the currency pair to trade. And if you just want to look at a bond yield spread, we'll look at the bond yield spread here between Australian 10-year bonds and New Zealand 10-year bonds. Now, do check out my blog. And I do give an explanation to HYCM clients, okay, and explain how to use this. I'll explain it very briefly now, but if you're unsure, go and check out my blog, blog.hycmlab.com. I go into some details. I'll just put it here. Right. There's me. Now, you see this bond yield spread. Do you see this bond yield spread? It's just the difference in bond yields between the Australian 10-year and the New Zealand 10-year. And what it does, it just gives you a heads up on what's happening with various currencies, okay? So see, when the spread is falling, it means the outlook for Australia is worse than New Zealand, right? So when we've been seeing a very hawkish RBNZ, we've seen the bond yield spread ticking low, and look, the Aussie New Zealand dollar has been ticking low, and I've been selling that on that, right? That makes sense. Now, recently, we're starting to see the bond yield spread pick up a little bit. Now, if overnight, if the Reserve Bank of Australia suddenly say, well, we're going to stop yield curve target, they've also told markets that they're not raising interest rates till 2024. Do you see the problem here? Because the Reserve Bank of Australia, Governor Lowe, has been saying, we will not raise interest rates till 2024. Money markets are pricing in 2 interest rate hikes next year. So which one's right? Futures markets or the Reserve Bank of Australia? That's the issue here. Now, I think the Reserve Bank of Australia are going to have to respond to rising inflation, like the Bank of England looks like they're going to have to, like the US start talking about stickier inflation, like the ECB talked about, we've been talking about inflation. Now, the RBA have stopped intervening using that yield curve control. So it's like they are worrying about inflation. So they may say, we may have to raise interest rates to raise inflation. If they do, this bond yield curve will rise, then the Aussie New Zealand dollar will rise, and expect that to be taken out in the first step up to that 1.0550. So look out for this. I've gone long the Aussie New Zealand dollar at market, but that's on the basis that I'm expecting a hawkish RBA. Now, if they're not hawkish, then obviously I'm wrong, and I would hedge the position. I'll just leave a hedge in overnight, and then I'll manage the hedge as we head back into 1.0300. Sometimes you can even make profit on getting the wrong direction. That's happened a few times before. So I'm happy to do that. Looking for a spike higher in the Aussie on a more hawkish RBA. So remember the base case. This is what you can look for. Do they end yield curve control? Hawkish. Do they drop the 2024 rate hike timetable and bring it forward? Hawkish. If they do they end quantitative easing early? Hawkish. Any of those things would be very hawkish. The other option would be like a pound Australian dollar. So selling the pound Australian dollar would be another potential opportunity, because the Bank of England is supposed to be very, you know, maybe more dovish than the market is expecting. So pound Australian dollar would be another potential opportunity. Okay, folks, that's that. So that's the RBA meeting. We're now going to look at the employment change for New Zealand. Now, obviously, if the RBA are hawkish, and this is a bad miss, so say the miss comes in, you know, minus 0.0%, unemployment rate rises to like 4.5%, something like that, and that would open up more Aussie New Zealand dollar downside. So just remember, whatever happens with the Australian dollar is going to be pushed and pulled around by the New Zealand dollar, because the Aussie New Zealand dollar pair is being governed by the outlook for the RBA and the RBNZ. So as long as you've got that in your head, you'll be fine. Wednesday, got ADP non-farm employment change. That does set the mood for non-farm payroll, likely to be ignored, because the main event is the FOMC statement. Similarly with the services PMI, might set the mood music heading into the FOMC. So if that's a good beat, you know, 650,000 plus. If that's a good beat, 63 plus, then expect dollar strength into the FOMC. Now, what's going to be crucial here is how do the Fed respond to rising inflation? Do they raise interest rates? Do they show concern? Do they bring forward interest rate hikes? That's what the market's going to be really looking at very, very carefully. Now, if they're more dovish, if they're more sort of you know, cautious, and they don't want to raise interest rates, they're expected to taper and announce tapering. Now, tapering is when they, you know, begin the end of their asset purchase program. That's expected to end the middle of next year. So this is what we need to look for. If they delay the end of tapering, then that would be very dovish. And we expect dollar downside, strong gold upside. If they accelerate tapering, that would be more hawkish. So if they say we're going to start tapering and finish by spring next year, you'd expect to see some dollar upside, gold downside. Then we need to look at the interest rate hikes. When do they see the first interest rate hike? If they bring that forward and say we see the first interest rate hike at the first half of 2022, then that would be more dollar upside, gold downside, and downside for equities. So we just need to watch that FOMC meeting, and potentially the good opportunity is there in gold. So the best opportunity we want is, you know, any dovish action, anything saying we're not worried about inflation, we're not going to be raising interest rates in a hurry, we think inflation is transitory, we're already seeing signs that it's passing, anything like that, then expect the dollar to fall, yields to fall, and gold to rise. That's the key thing. That's the best opportunity. Just like with the Aussie dollar, the best opportunity is if you have a hawkish RBA, because so many leverage funds are short. So that means they've got to unwind their positions, and that pushes the Aussie higher. UK, wow. Now, there's a problem here for the UK, and let me explain what that problem is. Right, I'll just go through now to the issue. Right, here's the problem. Right, this is the SONIA futures, right? And this tells you what money markets are pricing in the Bank of England interest rate hikes. Now, the way you calculate this is easy. You just take the contract, so we'll take the Z contract for 2022. So that's December 2022. You can see you've got 98.71 reading. So the current interest rate of the Bank of England is 0.10%. So all you do, you take 98.71, add the current rate, so that gives it 98.81, and then subtract 98.81 from 100, and that leaves 1.11. So what that tells us, sorry, that leaves 1.19. So what that tells us is that interest rates are expected to be an implied contract rate of around 1.2%. So in other words, there's 4 full 25 basis point rate hikes being priced in next year, would you believe it, for the Bank of England. So now these money markets have been responding to all the comments out of the Bank of England. We're worried about inflation. We might have to act to control inflation. Governor Bailey, Pill, a number of people have been worried about it. So all of that has just increased expectations for pound strength. But if you notice, the pound has not been strengthening because investors are not convinced by this. Okay, they're not convinced that the Bank of England is going to be raising interest rates that quickly. So there's a real opportunity if the Bank of England on Thursday say, we really don't think that we're going to be as hawkish as the market is thinking. Something like the pound CAD makes a lot of sense. We had the Bank of Canada meet last week, if you remember. They were pretty optimistic. They brought forward interest rate hikes. They announced the end of quantitative easing. So it hasn't been surprising to see some CAD strength against the pound. And you can see here on the intraday chart, this was the Bank of Canada interest rate decision. Here saw some heavy selling in the CAD, made sense. And now we see prices just flirting around that key support level. So if we do get if we get the Bank of England pushing back against those SONIA futures rate hikes and say, if they fail to raise interest rates, for instance, then expect more pound CAD downside. So this is a good opportunity. Risk can be measured just below this trend line. If we got like a pop-up higher before the end of the week, back up before Wednesday or Tuesday lunchtime, 1.700, that would be suitable for shorting. Okay, looking for a more dovish Bank of England. I don't think it's likely the Bank of England is going to be going on a rate hike cycle. If they do, they risk hindering growth, you see. That's the problem. Interest rates hikes make conditions more expensive for companies. And if conditions are more expensive for companies, their debt levels are higher, their debt repayments more, that means they make less profit, they're less likely to hire workers. So it's not a great environment for markets, and that's really what's going on there, okay? So key one, Thursday. I'll cover that again. We'll go into it in more detail. And we'll also look at on Thursday, so we'll get you totally ready for that. Friday, obviously got employment data. Employment's very important for the Bank of Canada. So that's liable to play into the outlook. So if the Bank of Canada are expected to keep their hawkish stance, then if employment is strong, that just keeps that alive. Anything negative here, then we could see a little quick retracement in CAD. A lot of good news already priced in for the CAD. So the best opportunity would be on a miss. So that would be like, anything below 100,000 unemployment rate, anything above 7.2 thousand. NFP is going to be important, of course, for the US, but has to be read in light of the FOMC statement. A big miss here would again be good for gold, weak for the dollar, and good for equities. So unemployment rate, anything above 5%, and employment change, anything below sort of 250,000, and anything like below 0.1%. If you had all of those metrics come in below expectations, expect dollar weakness and gold upside. So just remember, depending what happens on Wednesday, that will potentially open up the opportunity for gold as well. And then look at the NFP to either confirm or contradict the Fed's latest move. Okay, folks, that's been a whistle stop tour. Huge week. So do stop in to the webinar. Yeah, pound CAD trade idea spot on, Forex 101 right there. Yeah, thank you, Max. That's that pound CAD idea was spot on. So, folks, thank you all very much. Please take care. Have a great week, and don't forget, pop back in on Wednesday. Really looking forward to seeing you all, and come on in. And I've got a special on Wednesday. Don't miss it. I'm really going to show you how to get high reward, low risk entries. And if you're struggling with your entries, just don't miss Wednesday. Take care, folks, and have a good week. Thank you.